All right, let's talk about something that trips up pretty much everyone when they look at a company's financials, even seasoned pros: corporate income taxes. It seems like it should be simple, right? But it's a real puzzle, and today we're going to solve it together.
Yeah, you're scanning an income statement and you see that line item, income tax expense, and you think, okay, simple enough. That's what they paid in taxes. But then you flip over to the cash flow statement, and the actual cash that went to the government, totally different number. It makes you wonder, right? Is this a typo, or is this some kind of shady accounting trick?
Well, believe it or not, the answer is neither. It's not a mistake, and it's not a trick. This difference is actually a core feature of financial accounting. It's totally by design, and we're about to break down exactly how and why it works.
So, the whole reason this puzzle even exists comes down to one fundamental concept. Companies, especially public ones, live in two different worlds. They are literally required to keep two separate sets of books, and each set of books follows its own very different rulebook.
And right here, this is the heart of the matter. On one hand, you've got the rules for investors. We call them GAAP, generally accepted accounting principles. Their whole goal is to give you a smooth, predictable picture of how the company's doing over the long haul. But on the other hand, you've got the tax code. And let's be honest, the IRS has a much simpler goal. How much cash does this company owe us right now for this year? And because those two goals are different, you get two different sets of numbers.
So, okay, different goals, different rules. But how does that actually lead to different numbers on the page? Well, it almost always boils down to one simple thing: timing. It's all about when you recognize income and when you recognize expenses.
And that brings us to the key technical term here, a temporary difference. And you got to focus on that first word, temporary. This isn't about tax evasion. It just means that even though the numbers are different today, they're going to even out in the future. The difference will reverse. It's just a timing mismatch between what the company reports to investors and what it reports to the IRS.
Let's make this super concrete with a few examples. Think about depreciation. For its investors, a company might say, "We'll depreciate this new factory machine nice and evenly over 10 years. But the tax code, wanting to encourage businesses to spend money, might say, "Hey, go ahead and deduct a massive chunk of that cost in the first year." See? Same total amount deducted over time, just way different timing. The same thing happens with stuff like warranty expenses. For investors, you have to estimate and book the cost as soon as you sell the product. But for tax purposes, you can't deduct it until you actually pay out a warranty claim.
Okay, now to really lock in this idea of a temporary difference, it actually helps to look at its opposite, and that's something called a permanent difference.
And just like the name says, these differences are permanent. They are items that show up on one set of books, say the investor report, but will never ever show up on the other. They don't resolve over time, so they're not part of this timing puzzle we're trying to figure out.
A classic example: a big government fine. The company absolutely has to report that as an expense to its investors, but you can bet the government is never going to let them deduct that fine to lower their tax bill. Or think about interest from certain municipal bonds. It's income the company earned, for sure, but it's often not taxable. See? These are permanent gaps, not just a matter of timing. Okay, so if we have all these timing differences pulling the two sets of books apart, how in the world do accountants bridge that gap? How do they connect the GAAP world to the tax world? Well, they have a really clever tool for that, and it's called deferred taxes.
Let's start with the first part of this bridge, the deferred tax liability, or DTL. This pops up when a company gets to pay less in taxes today than what its investor-facing income statement suggests it should. Remember that accelerated depreciation? They got a huge tax break now, which means their future tax breaks will be smaller. So they book a DTL. It's literally like an IOU to the government for taxes they know are coming down the road.
And then you have the flip side, a deferred tax asset, or DTA. This is what happens when a company pays more in cash taxes today than its income statement would imply. Maybe they got paid up front for a big project. That cash might be taxable this year, but for accounting purposes, they haven't earned it yet. So in a way, they've prepaid their taxes. A DTA is like an IOU from the government. It's a future tax deduction they've already got in the back.
So let's recap. We've got two sets of books, we've got temporary differences, creating a timing gap between them, and we've got deferred taxes acting as the bridge. Now finally, we have all the pieces to put this puzzle together and solve that mystery from the beginning.
And here it is. This is the big reveal. That income tax expense you see on the income statement isn't just one number. It's actually a super simple formula. It's the cash tax the company owes the government this year, plus the total change in all those deferred tax IOUs we were just talking about. So just to be crystal clear, current tax expense, that's the actual check they're writing to the government for this year's taxes. And deferred tax expense, that's simply the net change in their IOUs. It's the total amount their deferred assets and liabilities shifted up or down during the year.
All right, enough with the theory. Let's make this real. We're going to walk through this example for a company called Lucas Company and see exactly how the math works out in practice.
Okay, let's break it down. First up, step 1, the current tax expense. This is the cash they owe right now. We take their taxable income, which is $1 million, and multiply that by the 40% tax rate. Boom, $400,000. That's the check to the government. Now, step 2, the deferred part. We look at the change in those IOUs. Their deferred tax liability, the IOU to the government, went up by $10,000. And their deferred tax asset, the IOU from the government, went up by $8,000. So, the net effect? A $2,000 increase in what they'll owe later. That brings us to step 3. We just add them up. $400,000 in current tax plus the $2,000 deferred part gives us a grand total of $402,000. And there you have it, mystery solved. The income statement that investors see shows a total income tax expense of $402,000. But the company's cash flow for the year only shows $400,000 going out the door for taxes. That missing $2,000? It's not missing at all. It's sitting right there on the balance sheet as a net deferred tax liability, just waiting for a future year.
So at the end of the day, the big takeaway is this: that income tax expense line is always a blend. It's a mix of the taxes due right now and the change in taxes that will be due down the line. It's the accounting system's way of giving you a complete picture, balancing the here and now with the long-term view.
So, okay, now you get the mechanics of how it's all calculated. But this really leads to a much more interesting, forward-looking question for anyone digging into a company's financials. Remember that deferred tax asset? That's an IOU from the government. But here's the catch. It's only valuable if the company's actually profitable enough in the future to use it. So the next time you see a company with a giant DTA on its balance sheet, you have to ask yourself, is that a sign of incredible confidence in future profits, or is it a huge, risky bet that might never, ever pay off? Now that's the real puzzle to solve.